Good morning. We'll just wait for a couple more people to join. Fantastic. Okay, so I will start today. Just quickly before I go into it, if you are here and your camera is on, if I could just politely request for you to switch your camera off and go on mute. Although it'd be absolutely lovely to see you, I think it might cause an unnecessary distraction. Without further ado, we'll start with today's Building a Better Future for First-Time Buyers webinar. So good morning. For those of you that don't know me, I'm Andy Alvarez. I'm the National Intermediary Distribution Manager here at Leeds, and I'm really thrilled to host this important session as we aim to explore ways to enhance our expertise in supporting first-time buyers. So as I'm sure you'll all agree, first-time buyers, they are the backbone of a healthy housing market. And as industry professionals, we have the opportunity as well as the responsibility to help guide them through what can sometimes be a very challenging journey to home ownership. Today's session is designed to provide you with the insights, tools, and support to do just that. So we've carefully crafted an agenda that focuses on the key issues facing first-time buyers in today's market. So today we'll be covering by having a closer look at the current landscape for first-time buyers and the trends shaping their decisions, the growing importance of shared ownership schemes and how they can benefit both your clients and your business, practical strategies for supporting first-time buyers as they navigate the property market for the very first time, and we'll be taking views from both high street and specialist lenders to see how we can support first-time buyers with unique propositions, as well as an introduction to Leeds Building Society's new range of first-time buyer mortgage products, featuring the very innovative Income Plus range that I'm sure you've heard so much about. And that is designed to help first-time buyers borrow more money without the need for a larger deposit. So today, we are very privileged to have an outstanding panel of speakers who have a wealth of experience and knowledge in both the mortgage and housing sectors. So today, I'm going to be joined by Clive Sandom, who's our corporate account manager here at Leeds, and he is a specialist in new build and shared ownership markets with over 20 years of industry experience. Many of you would know Kelly McCabe, the managing director at the Mortgage People, who is a passionate advocate for first-time buyers and is one of the leading voices in shared ownership within our industry. Ian Scarrett, who's a key relationship manager at Precise, who is renowned for his dedication to educating brokers and delivering tailored lending solutions. Catherine Jarrett, who's the Director of Sales and Marketing at Bromford, who has championed improvements in customer experience for first-time buyers and shared ownership customers. And last but not least, Mornay Jacobs, who is the Director of New Build at Countrywide Surveying Services, who is an expert in the new build and affordable housing sectors, with a proven track record of forging strong relationships with stakeholders across the industry. Mornay is going to be joining us for the panel debate at the end, and he will give a full review of the process. As I'm sure you'll all agree, each of our speakers brings a unique perspective, and I'm really confident that you're going to leave today's session better equipped to help support your clients in the journey towards home ownership. Please share your thoughts, ask questions during the Q&A at the end, and take full advantage of this opportunity to learn from our experts. So, without further ado, to kick us off, I'll be handing over to Clive Sandom, who's going to be sharing his invaluable insights into enhancing the customer experience for first-time buyers and practical strategies for supporting those entering the property market for the very first time. So Clive, I'll hand over to you.
Thanks, Andy. I'm just trying to take over control of the slides so I can move on, but that seems to be a bit of an issue. So anyway, yes, I'm Clive Sandom. I'm the corporate account manager for Leeds Building Society. Hooray, there we go, it's worked. And I'm going to be talking a little bit about why we're in this position at the moment, talking about first-time buyers, but for looking back in the history of house building, and then moving on, as Andy quite rightly said, about all the solutions that lenders, brokers, housing associations, and developers are coming up with to try and make that situation easier for first-time buyers. And actually, I think there has been an improvement recently. So if we do look back, my first slide here shows you the history of house building, sort of over the last 50 years. It's long since been the desire in this country to build around about 300,000 homes a year, just to keep pace with a population growth and demand. But as you can see from this graph, that's been not achieved since the sort of mid-70s. So there's been a sort of a steady decline. The odd sort of peak and trough in that graph as a result of mainly of government interventions, things like Help to Buy, which improved the situation, and then things like the credit crunch and regulation that came in that sort of slowed down the demand for housing at that time. I suppose what's most sort of indicative is if you look at the bottom graph, you can see that although private house building has remained at a pretty constant level, although it's been going up and down with demand and supply since the sort of 60s, whereas the supply of public housing or affordable housing has dramatically declined. And that's why we're sort of in a situation now where first-time buyers are finding it harder and harder to get on the housing ladder. The current government have pledged to build 1.5 million houses over this parliamentary term, and there are quite a few headwinds in way, but hopefully we will achieve that with the help of some of the incentives and projects that we've got going at the moment. So if I can just sort of move on to the next slide. This is okay. So the challenge that face first-time buyers, first one, which was illustrated by the graph previously, is rising house prices. HPI will show that in the last 10 years, house prices have risen by about 76%. Unfortunately, incomes haven't risen by quite as much. So the disparity between house prices and incomes is now probably around about 10 times. So the average salary being around about 30,000 and the average house costing 300,000, 10 times the salary to get yourself on the housing ladder is a difficult obstacle to achieve, and about twice as hard as it was about 30, 40 years ago. Also, actually building a deposit, because obviously house prices are higher, finding a deposit large enough is a problem for first-time buyers. And obviously, because of that, the affordability issues have become even worse. Access to credit, mortgage regulation has been very successful in avoiding people getting into financial difficulty, but it also has restricted the amount of people that have been able to access mortgage finance. And that's another thing that the government have mentioned that they are proposing to look at in terms of relaxing some of the regulation around mortgages and stress rates that lenders have to adhere to. And then finally, just education. I find that first-time buyers generally feel a bit bamboozled about what is available on the market, and it's part of our role to sort of educate and let people know just exactly what they can do and different schemes that they can access. More information on this can be obtained by scanning on the QR codes on this screen, and these slides are available afterwards. So, sorry for the delay in moving on the slides here. As a lender, Leeds Building Society has made it one of our main purposes is to get people on the housing ladder, and first-time buyers in particular. So we've brought out a range of products and services to help that. What I'm not going to do today is, go through everyone individually, mainly due to time restraints. But I think what you will see is I'm going to highlight one or two of those products. If I can get the slide to move on. So this is where you can find information on our products and services moving forward. Obviously, we offer video podcasts like this one. There's collateral that you can download. You can go onto our website, and also we provide insightful thought leadership and trade press. Sorry, I'm just trying to move on to the next slide again. Here we go. So recently, as Andy mentioned, we have launched a really important range of products to help first-time buyers on the market, and we call it Income Plus. I'm aware that obviously other lenders have done something similar. Accord and Skipton have also been at the forefront of releasing products to help first-time buyers. Our Income Plus product is aimed at first-time buyers with a minimum income of £40,000, where they can borrow up to 95%, and we'll do up to 5.5 times income for those customers. It's a 5-year fixed rate, and the key thing to it is that customers are able to borrow on average around about £66,000 more than if they'd gone for one of our standard range of products. So, and it's proving to be really popular. Since we launched a couple of months ago, we've seen a massive increase in applications for this product. So if you haven't done so yet, please do check it out on the website, and you'll be really impressed. But make sure that you have first-time buyers that are earning more than £40,000 and use the calculator that is appropriate for these products. Another range of products that we've recently released is our Reach range of products. Now, these products are slightly different in that they are designed for those customers that don't quite achieve the credit score to qualify for our prime range of products. So these are people who've got, if we're looking at sort of an average credit score, there's slightly below that, and it just allows them access to mortgage products at a slightly higher rate, on average about 0.25% above what our standard rate products are. Again, we've launched this some months ago, and this has been very successful in allowing more people to get onto the housing ladder. Another thing that we've paired up with is, if we can just go back a slide there. James, can you make it go back a slide? Sorry about this. No, we've gone forward one. Right, there we go. Experian Boost, fantastic. Thanks for helping out there. So Experian Boost is something that we've paired up with Experian to help clients with low credit scores by boosting their credit score, because we can access their payments to regular payments such as council tax, Netflix, for mobile phones, and it just helps people get a slightly higher credit score, and as such that will hopefully qualify them to get a mortgage. Clearly, one of our key products is shared ownership, and we lead the market in shared ownership. We've long since been a go-to provider, for shared ownership mortgages, and in connection with our builders who are now offering great incentives for get first-time buyers on the board. More and more people are qualifying for mortgages and buying the dream of their home of their dreams. I just said the dream of their homes there. Talking of dreams, we'll now pass over to Catherine Jarrett, who will be able to tell you more about shared ownership and what a marvellous product it is. So,
thanks, Clive. Good morning, everyone. Thanks for joining this morning. As you can see, there is a bit of entertainment with us moving the slides forward. So I'll have a go, and if it doesn't work properly, Kelly and I will ask James to be our glamorous person doing the slides for us. So we'll have a go and see if it works. This is where I pressed it. We'll go through 17 slides if we're not careful. James, would you mind moving us forward one? So just thought I'd do a very quick introduction to my esteemed colleague. Kelly's been the MD of TMP for a number of years. I won't say how many because that ages both of us. She's very passionate about shared ownership and is a leading voice in this space. She runs the exchange as well as her business, and is always a great place of knowledge for me as a housing association and my customers as well. Move us on to the next slide, please. So what we're going to cover today will be really helpful, hopefully, for everyone. So first of all, understanding the landscape for first-time buyers and those buying shared ownership. What is shared ownership? And Kelly and I are going to do what hopefully won't end up to be too comic, backwards and forwards on the shared ownership journey, but we'll wait and see. Thank you. So understanding the landscape for shared ownership and what does it mean, as echoing what Clive said earlier about how difficult it is for customers to get a deposit together now. Shared ownership is one of those spaces that can really help those customers. From a Romford point of view, we know most of our customers are single, they have a single income, and they tend to put in about £22,000 worth of deposit, as opposed to what a normal first-time buyer would put in on the open market, around 70,000. Most of them don't have any dependents either. Now, Kelly can give us some more data on what she's seeing from a much wider landscape at TMP.
Yeah, the average customer has changed over the years, and despite the changes externally, there have been some things that haven't really changed. The average age of customers we see is still in the kind of 36, 37 range generally. Deposits are still more often than not 5% deposits. But the makeup of those deposits is the things that have changed the most over the years. What it used to be was savings, and you could see a build-up of those savings, but we're seeing now more often than not that these are gifts. And so those incoming deposits are coming from different sources, which can present its own challenges. But our customers are, they're changing in the sense that it used to be that shared ownership was the fringe product and not very many people needed it, but now it's the bread and butter, and the majority of the kind of average person in the UK, most people would qualify for shared ownership.
Next slide, please. So what is shared ownership? It's a housing scheme that allows you to purchase a portion whilst paying rent on the remaining part. There is a little more complexity and nuance to it, but if you're looking at a basic term, that is what it is. Next slide, please, Jane. So I thought this was a good place to start. So shared ownership's been going for over 4 decades now. So it's in its 40th, past its 40th birthday. Certainly I know what that feels like. Yeah, all the good ones, yeah, absolutely. So over that time, it has changed. There's been all kinds of different things that the government has done to try and move it forward. And the most recent one has been the new model shared ownership lease. So it is a reliable, established, long-running product, and from a customer point of view, I think that's really key to point out. Next slide, please. So most recently, 2021, we had a change to the shared ownership lease. And I'm not going to read the whole thing to you because I'm worried that people might abandon the webinar. But some of the key things that are on there are the increase in repairs and maintenance contributions from the housing provider. So that's essential and genuine repairs. Up until now, customers have had to pay for all of that, though they might only own like a 25% share. And the other one is the lower minimum initial share of 10%. Previously, it was 25%. And customers can buy 1% a year as well for the first 15 years. So some changes, listening to customer feedback to help this be a more dynamic product for customers to be able to move through their journey with shared ownership, which has always been that you would eventually buy the entire product. Next slide, please. So it's always good to also have a look at where we are. So there have been just over 200,000 shared ownership products, homes that are currently owned on a shared ownership basis. There have been over 400,000 that have been built. So that means over 200,000 customers have moved forward into either selling their property and moving on to something else, which we see, or actually buying their home outright. And certainly we are seeing more and more customers buy shared ownership for a second time as well, which is good to see. So the product worked for them initially, they've changed location and they're buying again. I think some of the other things to say are that the average amount of customers buying has dropped. And Kelly, I don't know what you're seeing, but we're seeing ours now just scooting under the 40%, which is unusual in the 6 years I've been in this market.
Shares are directly linked to affordability and interest rates. And so where we've been in a market or a climate, I suppose, of changeable interest rates, the impact of that is that customers' affordability is directly impacted. Shared ownership has a unique kind of measure within there in the share. So I'm sure lenders will have seen marginal drops in their loan amounts, and what we see in shared ownership is the share amount reflecting that possibly more acutely. And so I think I don't think I know what we're seeing is that shares are starting to pick up again. We're starting to see more customers buying the slightly larger shares because the interest rates have started to kind of balance out and level out. So if we're expecting the next few years to be more stable and a slight downward trend in some of those longer term fixed rates, what we'll see is those shares will begin to match and will move back to the kind of plus 40s that we were seeing before.
Yeah, and we'll wait and see what happens at lunchtime today with the interest rates. Always very exciting. Must get out more. Next slide, please. So why do customers end up looking at shared ownership? Certainly, whilst we all do in housing associations and wider a lot of publicity as far as we are concerned as to what shared ownership is, it's still a very unknown area of the housing market. It's not the first thing that people think about. How do customers find us? Rightmove, brokers, family and friends, those tend to be the main reasons. And the main reasons they end up with us are because they're usually trying to buy by themselves, don't have such a high deposit, and also the cost of buying outright is just too much for them. So on here, it gives you some of the thoughts about why they might do that. So what are the issues they end up with? It's a very specialist product. So one of the issues I wanted to just bring up here was the lack of knowledge. And obviously, people on the call are hopefully increasing their knowledge as to what shared ownership is with this webinar, which is great. But the lack of knowledge with solicitors and mortgage brokers, the guidance and support these customers get can be quite tricky. And there's also no other scheme to help them buy their homes properly at the moment. So with that in mind, I'm going to hand over to Kelly, who's going to talk to you about a more affordable way to buy.
Thank you. So some of the basics of the product are the most important things that we as the broker community can learn, because the advice that we give to our customers, what we want to make sure is that that doesn't conflict with the housing associations and Homes England's advice. So understanding the basics of the products really help that. So as Kath's already said, you can buy between 10 and 75% of the property, but it's not that straightforward. It's not a choice necessarily that the customer can make. And so that's important, and we'll come back to that. But you pay, the customer will pay rent on the remaining share, and that is an upward increasing rent. Again, really important for when we're looking at suitability of products for customers, when we're looking at affordability, and when you're looking at known changes for our customers, we know the rent is going to go up. It will never come down, it will always go up. So they don't rebase rents. So what I mean by that is that they don't look at the value of the property and recalculate the rent at that point. That initial calculation stays. The home is treated as their own. So, you know, there's none of the sharing aspect that some customers get confused with. So it is theirs. They have all the rights and responsibilities. And what goes with that is that if they want to put pictures on the wall, they can. If they want to paint their walls black, they can. There's no need to, lease depending, ask if they can have a pet. It is very much their own home, but the cost of that goes with it. Next slide, please. So eligibility is the key one here. Before we even talk affordability, we have to make sure customers are eligible, and this can be sometimes where things fall down. So there's some basics on there, like you need to be at least 18 years old, that's fine. Annual household income is less than 80,000. Just as a caveat to that, if it's within London, it's up to 90,000. But really key that that's understood. It means that if mother is buying and son is over 18 and in the household but not being named on the mortgage, his income will go towards household income, and that's a very strict eligibility rule. You need to not be able to afford to buy that property on the open market. So bear that in mind. If this is a choice, a customer choice, that they would rather buy shared ownership than a property on the open market, if they could afford to, they can't buy shared ownership. Local area connections, there's other things within there that sometimes come into play. Affordability is key, but the last one that's really important is that they can't own another home, and that's anywhere in the world. So bear those in mind, because again, from a broker perspective, when we're talking to a customer, what we don't want to do is build their hopes up that they definitely can do this. Then we pass it over to Kath, and Kath is the bad person because she says, no, they're not eligible. Next slide, please, James. The benefits are, as we've already said, you know, it's their home and they can treat it as that, and they're never going to have a landlord inspection. It is very much home ownership, just with a bit of a twist. The shares are more flexible these days, so being able to buy those smaller shares is an option, not always a good option, and that comes down to our advice. And what's key is to really explore customers' affordability to see what the optimum share is. It's not about maximising the shares for the housing association, it's about optimising the shares for the buyer and making sure that they are achieving the right share for them at the right time. Shared ownership is leasehold, so every property that is shared ownership will always be leasehold, whether that be apartments or houses, and that won't change because of the nature of how it's made up. Next slide, please.
This is where we tag team along. For those watching, we haven't practiced this, so this could be very entertaining from everyone's watching point of view. So what is the process? So as a housing association, I advertise on my website, Zoopla, sometimes Rightmove. My home's coming soon. Customers can register. At the stage we release those homes for sale, we also let our brokers know. because they've then got quite a lot of work to get started on. We would then contact our database all at the same time, saying the homes have been released, and then move customers through the first come, first serve process. And this might be the first time you've heard about that. You might be an old hand at it. So we're just going to walk through. So the customer will then be directed to the mortgage advisor. So as they contact the mortgage advisor, Kelly takes over.
At the point that we receive the applications, each housing association will have their own first come, first serve policy. And it's part of our responsibility as a panel broker with the housing associations or RPs to ensure that that first come, first serve policy is delivered properly. So important to know what they are. A lot of them look very similar in that it's based on the time and date stamp when they either contact the housing association to register their interest or when they contact the panel broker to complete the affordability assessment. We then go through that initial assessment, which I'll come on to later, and we establish that they can afford to buy the property. Share irrelevant. Just do they fit on the basic criteria between 10 and 75, or if it's an older lease, 25 and 75%.
Next slide, please, James. Over to you now.
We then, at that point, if the first qualifying customer in the queue, the first qualifying customer in the queue is then moved forward to a stage 2. So stage 1's been completed, stage 2 assessment then takes place, and that's when we collate all of the documents and we evidence and confirm the information that's been shared with us. At that point also, we will look at the mortgage situation. Now, if the customer wants to use us for their mortgage, that's when we would start to recommend the correct lender. If the customer is using another broker to arrange their mortgage, we then ask for evidence of what has been agreed, what has been arranged. That's packaged up and sent over to the housing association to essentially tick the box to say that this customer is affordable. We've seen the evidence, and that's normally within 5 working days. As it says there are different rules for vulnerable customers. If you have a vulnerable customer, it's really important that you highlight that or ask them to highlight that as early in the process as possible so that the housing associations can make the necessary arrangements. The budget planner is another key part of that. When we're running through affordability, the budget planner is set by Homes England. The parameters of the budget planner, I should say, are set by Homes England, and there are some key policies that those calculations have to meet. That one's called the surplus income policy, and each housing association will have their own surplus income policy that the customer needs to achieve. Once that's packaged up and sent off, it then goes, as I say, to the housing association, who can then proceed with the application and the reservation. Next slide, please, James.
So at the stage we receive that, we will check what's come through and make sure that we are in agreement with it, because we do have the right to be able to challenge some things on there. If a customer has 50% surplus income, it's likely that Kelly's team will get one of my team on the phone going, well, they're buying more shares, because actually that's a lot of money to have surplus at the end of each month. And we don't get that usually from Kelly's team, but we have had it elsewhere. We then send the customer a key information document number 2, which gives them more detail about the impact on them of buying that property, what that means on their rent, service charge, all of those sorts of things, and give them time to review that before we then book in the reservation. We always check with the customer if they're happy to book that reservation, and we will go through, as Bromford, all of the plans about the property, because very often we're selling off plan, go through the key information documents, make sure they've understood key information document 1 to 3, and then confirm that reservation, and the customer pays their reservation fee. Now, Number 12 says move through conveyancing process. We all know that's not going to be a quick thing, as we try and get the customer through that conveyancing process and then they exchange and complete. The last one on there, number 14, is most probably one of my little soapboxes that I like to stand on every so often, talking about how customers continue to buy more of their home. So go on to the next slide, please, James. Oh, then.
That's fine, I can pick that up. So as we've alluded to throughout this, there's two parts to the assessment. There's two parts to the customer affordability journey. And I'm not going to go into all the detail because we could probably run this session for about 3 or 4 hours. But the two key parts are the stage 1 assessment. It's a high level affordability assessment to ensure that that customer is eligible, number 1, going back to those eligibility points. But number 2, that they are able to buy a share. If we're talking resales here, that's slightly different because the share is determined. Whereas if we're talking new build, it's a share that sits within the lease. The newer lease, as we've said, is between 10 and 75. The older lease is 25 to 75. When we do the calculation, we don't use the pay rate on the rent. We use very much a lending style model, which stresses the rent over a 5-year period. So again, that's really important to do. If you're dealing with new build, they tend to be 2.75 or less. If you're dealing with resales, that could be a kind of wild figure that sits in there because of how long that lease has been in place. There's a mortgage eligibility check, which is that the mortgage payment can't exceed 30% of their net household income. Now, again, that's not a set in stone measure, but that's something that we use as a filter, as a general rule of thumb. If it's massively outside of that, it gives you a good indication that it's probably not going to be affordable for the customer. If it sits within it or just over, then that's one that's worth progressing with. And again, as I say, the eligibility check. So that's the first part, and that's what RPs and HAs rely on us to do, to ensure that the customers they're dealing with are the ones that can proceed. There's always an eject button for customers that if they were to be declined and they felt that they shouldn't be, that it is affordable and they can proceed, there's always a way that they can do that, and there's conversations that can be had. The stage 2 assessment, this is where, as I've said, we gather the evidence of the stage 1. So if that customer has told us that they earn, 45,000, that's when we're doing the checks, as we would do as standard for any mortgage customer. But we do those as a panel broker for our mortgage customers, but also your customers who are buying a shared ownership and using you to take out their mortgage. The important bit with this is that Homes England's guidance changed to state that it has to be a panel broker that does this now. That doesn't mean that we force all customers to use us. I would I'd drive a much nicer car if we did that. We don't. We do abide by rules and laws. And if a customer doesn't want to use us, they're your customer, they stay with you. We still continue to do this job for the Housing Association because that's the agreement that we have. But we do need to check this. This is not about us trying to kind of step on toes. It's part of the Homes England guidance. So not only do we check we check and evidence what has been declared in stage 1, we then establish that optimum share. And as I alluded to at the start, the shares have changed and the ability to choose a share is more freely available now, but choosing comes with its own caveats. And if I started to push over all of the shares at 10%, Kath would not be happy. But also it's unrealistic. We have to remember that a lot of these properties are grant funded. And so it's really important to make sure that customers are using their own means before using grant means. So we carry out AML checks in the main and financial crime checks. We confirm that optimum share. The budget planner is completed, and we also look for a 10% surplus after all of costs. That again is that surplus income policy I mentioned earlier. I won't carry on because there's lots of other kind of nuances to this, but generally that's where we sit. Kath?
Brilliant. And just ending on, when customers come to remortgage with you in their own shared ownership, please consider if they can buy more shares. this is always transitioning them forward to owning more of their own home. And that is really key with shared ownership.
And just on
Yes.
that, actually,
Oh, yeah.
what's been interesting, I realise I'm going off script now. Staircasing has been difficult for the past couple of years since the mini budget. Staircasing hasn't been something that's popular, but we've really started to see an increase in popularity of that. So if you are remortgaging your shared ownership customers, it's a really good conversation to have with them.
Yeah. And as a housing association, we do quite a lot of promotion of staircasing, buying more shares, and that really does sit with the housing association from an ownership point of view, but great opportunity if someone's sat in front of you. Next slide, please. So that's it from me and my colleague Kelly. I would now pass from a Jarrett to a Scarrett. Ian, over to you. I'm sure you'll have some great things to bring colleagues up to date with.
Thanks, Catherine. Really appreciate it. And thank you for the link. Yes, from Jarrett to a Scarrett. My name's Ian Scarrett. I'm one of the key relationship managers at One Savings Bank. Probably the first thing you're all asking is, why the heck is Ian here today? Well, I was very kindly asked to join you on this webinar just to give the alternative perspective from a specialist lending perspective, and where we pick up business that maybe that necessarily doesn't fit with the likes of the wonderful products with the Leeds Building Society, but also just to give a wider perspective of specialist lending within the first-time buyer market, not just focusing on shared ownership, but what we can do to help potentially in the wider first-time market and to support your clients on that journey to home ownership. If we just move on to the next slide, please, James, that'd be great. So I think there's little doubt that the UK mortgage market has changed rapidly over the past and continues to change, in fact, at a rapid pace, probably more than ever. And I think no sector within the UK mortgage market bears the brunt of those changes and ups and downs more than the first-time buyer market. And you only have to look at some of the stats on that slide, and I won't go over them all for you, to see the changing demographics of first-time buyers within the UK. And to paint a picture, certainly from the specialist lending perspective, first-time buyers, some might say, are facing some of the most challenging conditions of the last 50 years to purchase a home. Trying to save for a deposit in a cost of living crisis, battling rapidly rising rents, which statistics support that they rose by around 9.2% within the last year alone. House price rises, and of course, an increased rate environment, although all have our fingers crossed for what happens today. I mean, first-time buyers kind of almost face that perfect storm with not just the challenge of being able to save for a deposit, but then making sure that it's actually affordable when they get on the housing ladder in the first place. And these challenges have ultimately meant that first-time buyers, we're seeing them wait longer and longer to purchase the property, and that initial deposit size on average being larger and larger. The average deposit now looking at around £53,000 and taking a staggering 7 years on average for a first-time buyer to save that up to purchase a property outright. So the obvious benefits to what Catherine and Kelly were talking about, and the gap that shared ownership fills becomes really, really apparent. Thanks, James. But I think from a specialist lending perspective, whilst that market has changed, the first-time buyer market, the specialist lending market has evolved and changed rapidly. I mean, I've been lucky or unlucky, whichever way you look at it, to work in the specialist market now for just over 20 years. It's evolved just immensely over that time. It predominantly, when I started in the industry, was just about adverse. And whilst that is a really important part of it, and I'll touch on that in a moment, it is more than that. We're seeing more and more reasons why first-time buyers may come to lenders like Precise and Kent Reliance. It may be that they instead of just core adverse, they just need a no score or a low score lender. It could be that they've got complex income makeups and complex self-employed. They could have been only trading for 1 year. They could have challenges within their affordability, or they maybe just need flexible underwriting and an underwriter to take a more manual view. After all, how many of our clients really fit in that perfect little box nowadays? So where can we help and what products can we offer to support them, and what trends are we seeing at the moment? So the obvious reason, if we look at the next slide, that we pick up a lot of business that maybe doesn't fit with the high street lenders in the share ownership and in the first time buyer space is of course adverse. And you can't get a specialist lender on without talking about adverse. The first caveat I will give you before we talk about adverse and what we can and can't accept is that if you're thinking shared ownership, I'm talking about shared ownership and general first-time buyer solutions, is whilst lenders will have adverse rules, of course, shared ownership and housing associations will have their own rules as well on both affordability and adverse. So you need to ensure that it meets both of their requirements as well. So just to pop that in there. But we are at the situation now where adverse credit in the UK is becoming pretty endemic. I've been watching these statistics from Registry Trust for the best part of about 10 or 15 years, such as interesting is my life. And we're now at the point where, kind of CCJs, we're over 1 million CCJs registered a year. If you break that down by working day, based on the figures for Q3 in 2024, we had 4,523 customers every single day receiving a CCJ within the UK. And that's up 13% on the same period during 2023. So I'm sure many of you will be sat here saying, look, I don't get those customers and why would I want them? But the reality is there's lots and lots and lots of them out there. And it's a huge demographic, many of them in the young years, and many of those challenges that we talked about at the start, rising costs, cost of living pressures, are the same reasons why clients can't save a deposit or maybe struggling to save a deposit. It are the same reasons that lead to often these CCJs and defaults on the uptick. So we can offer solutions for them and the lenders out there. And I think many of those clients, their journey for them ends at the high street. If 3 lenders say no, are they aware of lenders like Precise Mortgages, Kent Reliance, and many of the other fantastic specialist lenders out there in the UK? The answer is most of them don't know we exist. So having a brilliant broker that understands can reach out to them and say, look, there are alternative solutions at sometimes high LTVs, sometimes being available with shared ownership. There are solutions available. So what can we do to help? On the next slide, you'll see a brief summary of the criteria available through Precise Mortgages. And we can help clients with up to 5 defaults within the last 24 months, everything after 24 months being ignored, CCJs up to 3 in the last 24 months. We can also help with missecured arrears on both mortgages and secured loans. Unsecured arrears across the whole of the Precise Mortgages range are completely disregarded. And we can even help with clients within debt management plans, etc. Now, Precise Mortgages only goes up to 85% at the moment, but we can add fees over and above. But please watch this space. We've got some really, really exciting developments across our lenders, both in terms of systems and the criteria we offer. Can't say any more than that, or else in case my boss is spying somewhere and I get sacked by the afternoon. But please watch this space because there's some really exciting announcements coming for Precise and Kent Reliance later on in the year. But Kent Reliance is really dominant in the higher LTV space and the first-time buyer space. And the key to understand the difference between Kent Reliance and Precise Mortgages, well, Precise Mortgages are a fantastic, simplistic product that can assist clients with great criteria and solutions. Kent Reliance steps in with really flexible manual underwriting solutions. No credit scoring, no computer-based decisioning, and manual, flexible, traditional underwriting. It was the way I was taught to underwrite 20 years ago at the Abbey National, if anyone's old enough to remember the Abbey National, when I was an underwriter there. Kind of real life justification of lending decisions, which many first-time buyers, especially in a more complex market with more complex incomes, really do see the value of. Thanks, James. So Kent Reliance, whilst it has standard term products that go right the way up to 95%, right through 90% products, 95%, and we have bandings all the way down to 65%. We employ that same kind of pragmatic human underwriting, the manual approach, flexibility on income multiples. The standard income multiple with Kent Reliance is 4.5 times, but we do have the facility to stretch that in the right circumstances for the right case. For 4.5, 5, I've seen it even stretch to 6 and slightly beyond. Again, it needs to, if you are looking at shared ownership, just bear in mind there are restrictions on that, but on the higher LTVs, for the right case, for the right client profile, we can stretch income multiples in certain circumstances. So it's always worth reaching out to your regional BDM, running the case by them to see what additional incomes we can take. We can take multiple income sources, not 1, 2. I've even seen 3 jobs potentially taken into an affordability calculation, as long as it makes sense and is sustainable in the long term. At 90% loan to value, we're one of the few lenders that has no maximum loan amount. So if you have high net worth clients that are looking for larger loan sizes, especially in the south of the country or central London, we can absolutely help and support that. And of course, just like with precise mortgages, we can assist on clients who have had credit hiccups and affordability issues driving those adverse challenges. For example, at 90% loan to value, small CCJs and defaults can be ignored completely, less than £300. Defaults over 24 months old and CCJs are completely ignored, even at 90% loan to value. And we can even assist clients with interest only up to 85%, subject to all the necessary checks being done. Thanks, James. But of course, we're all here to talk about shared ownership, and we do get involved in that as well. Yes, the dominant reason why we would get those shared ownership cases through the Kent Reliance brand is probably those clients that, yes, sometimes some affordability challenges drift our way and we can help with those, but also it's mainly those clients that maybe have had some credit hiccups along the way. Allowing clients to get on the property ladder as easily as possible in partnership with those fantastic people at the housing associations to purchase a share of the property, but also assisting them to kind of staircase along that journey. We can do the initial purchase and assist with remortgages down the line to assist with staircasing, potentially all the way to 100% property ownership. And I'll just run you through that criteria very quickly before I pass back. The big thing with the challenge that faces first-time buyers at the moment, as we've already discussed, is of course saving for that initial deposit. And I'm pleased to say that we're one of the few specialist lenders out there that offer, if any other specialist lenders out there, that offer a 0% deposit option. So we know that historically over 50% of Help to Buy first-time buyer purchases utilised the 5% deposit. So we know that high LTV, low deposit option is really, really important to first-time buyers. So we can allow potentially a 0% deposit, subject to, again, to it fitting with housing association. We'll consider the smaller shares as well. So we can now look at the sub 25% shares. Historically, we saw larger shares, but really great to hear Catherine and Kelly talking about those shares now starting to increase with the easing of affordability. And we can assist with anything above 10% share to get onto that property ladder into one of our shared ownership products. Everything we've talked about today with adverse and flexibility is also echoed throughout our shared ownership range, but of course, make sure it's fitting with your shared ownership provider as well. Thank you.
Perfect. Thanks, Ian, and thanks everybody. All of the people that we've had on our panel today. Some amazing information imparted, and some great product highlights showing the actual strength between sort of high street and specialist lending as well. We've had some great questions coming in. We want to try and stick as closely to time as we can, so we may not be able to answer all of them, but we will try our best. And if we can't answer them now live, we will do it after the webinar's ended. So now we're going to move on to our Q&A session, our panel debate. And the first question, actually, Mornay, I have for you, because we know a really hot topic at the moment, especially when anything new build is concerned, is in relation to incentives. And in some regions we've seen an increase in developers using incentives to encourage sales of new build property. What do you see are the implications to brokers and lenders on incentives, and do you think that we will see these becoming more common throughout 2025?
Yeah, hi, good morning everyone, and thank you. Very good question. It will be quite an interesting one to see. I think use of incentives really is nothing new. We've seen developers use sort of incentives to manage sales rates and sites for many years now, and especially when sort of industry and consumer confidence tend to sort of slow down a bit, we do tend to see sort of incentives sort of going up and down. So I think historically, if you sort of roll the clock back a little bit, historically, I think incentives sort of had a bit of a bad press. We saw some sort of conditional incentives and conditional sales, non-transactional incentives, etc. What I mean by non-contractual incentives is that it's not actually directly related to the sale of the property. And a couple of examples by that is that we've seen historically that gave it a bad press is, oh, well, if you buy this house, we see a car in the driveway, or buy this house, we can't complete in time, but we'll send you on holiday or whilst we complete. So, and that is typical incentives that really sort of, like I said, gave it a bit of a bad press. But the good thing is, I think the industry has moved on and we've moved away from that. And incentives are actually now sort of could be seen as a good thing, especially sort of meeting those consumer needs. I mean, we spoke about affordability several times today, and especially the use of sort of shared ownership and that side, because especially for first-time buyers, affordability, getting onto the property ladder is a major challenge. And use of incentives could really sort of support that transaction, because we see the likes of deposit paid incentives, legal fees, and that side of things. So for me, as long as the incentives are not excessive, it's seen as sort of it's deemed responsible, and therefore that shouldn't really be seen as a negative. Really, I think it's excessive incentives, irresponsible incentives could really sort of affect the valuation of the actual property. We could also see potentially lenders start restricting some of the products and the loan amounts. So overall, I think the biggest thing is for consumers to really consider the types of incentives that's on offer. So just sort of in conclusion with that, incentives could be sort of seen as a good thing, but just be aware of some of the drawbacks. And I think brokers really play a key role in this and actually supporting and guiding consumers in terms of what their actual needs are. So yeah, absolutely, it's nothing new. And yeah, really no major concerns as long as it's responsible, really.
Perfect, Morley. Thank you very much for such a comprehensive answer. Next question I have, and Kelly, if I can direct this to you. How do brokers work out affordability for shared ownership now that the calculator has been removed from the Homes England site? And this is something that comes up quite frequently as well.
The guidance is on the Capital Funding Guide. Now, the removal of the calculator, I know, has maybe caused problems for some brokers because it was a kind of one size fits all, click a few buttons and you had an answer. But the new guidance, there's a list of calculations in there that you need to do. Homes England left it to brokers to create their own calculators. We did it. All the other brokers that work in the space have done it too. You can create your own. It's an Excel spreadsheet, put it together, and if you follow the calculations within the guidance, it will give you those answers and they will match wherever you're going. The important thing to do though is to really understand what the Capital Funding Guide is asking for. And what we see, not all the time, but what we do see sometimes is that the guidance hasn't been followed. The customer has been told they can have the property. It lands with us. We follow the guidelines. And then there's obviously this disparity between our outcome and the other broker's outcome. And then what you've got in the middle is a really unhappy customer, which I can understand. So following that guidance is really key. Understand it, read it, take 10 minutes and go through it, create your own calculator, and the outcomes will take care of themselves. But again, we've mentioned this, Ian, you mentioned it. It's really important to understand the housing association you're working with. Even if you get the calculator right, if the customer's got adverse and that goes against the adverse policy as published by the RP or the housing association, it won't wash. if the surplus income is too low or too high, and the surplus income policy, the rationales don't support it, it's going to be a problem. So it's very much about get those calculations, understand what's being asked, understand what goes into them. I've just had an email from somebody that's on the call at the minute to say, can you help me understand what household income really means? And that household income is very much any income coming into the home that the lender would use. So that was clarified a little while ago by Homes England. So if you have a customer who earns £100,000, but actually £40,000 of that is bonus over time, that kind of thing, and the lender will only take 50%. Homes England have confirmed that they would also look at taking 50%. So it's key to make sure that if you're putting somebody forward, you understand how their income is made up, and you plug that into the calculator, not what we think should be in there.
Perfect, Kelly. That is really helpful, because I know that's a question that comes up a hell of a lot.
Sure.
Thank you for that. The sort of next question I'll throw out to the panel, because we've seen a rise in I suppose you could say interest or appetite from a lot of lenders wanted to support a lot of first-time buyers. What are the current positives, do you feel, for first-time buyers and brokers actually serving the first-time buyer in this market?
That's a good question,
I think,
Andy. Oh, sorry.
No, go on, Clive. You jump in first.
Okay, yeah. I was just going to say that, first-time buyers are the bedrock of our industry at the end of the day. And so if we don't support the first-time buyer market, we lose the market as a whole, basically, because it's like a funnel, it's like a snake eating a rat. It gradually moves down the tube and everybody benefits in the end. So we've already discussed how difficult it has been for first-time buyers, but we've all demonstrated today that lenders, brokers, and everybody's trying to make it easier. And I think it is getting slightly better with all the product innovation and what have you, but we've still got a long way to go. It's very important that lenders do support the first-time buyers moving forward, and that more houses are built. But Ian's probably got a bit more to add on to there. So.
No, I was going to echo something. You said exactly the right thing. First of all, I was going to say first-time buyers are the future wealth creators. So I think lenders always want to support them. It's certainly been a big part of what we've tried to do at both Kent and Precise Mortgages. Precise historically a massive help to buy lender within the industry, and Kent's always played in that high LTV share ownership sector. I think the reason a lot of lenders are starting to turn to it is one, I think there's a lot of pent-up demand within the market at the moment for first-time buyers to buy, and a lot of people are predicting that actually 2026 could be the year that starts to release with proposed base rate reductions and affordability metrics starting to look a little bit better. There was a survey done recently that said 70% of first-time buyers think they'll buy within the next 2 years alone. I know that's there's probably a lot of optimism mixed in there, but I think there's a huge amount of people that have not been able to buy or have been cautious over the last few years. But I think from a lending perspective as well, there's also a lot more competition I'm seeing within sectors. If you take Precise and Kent, for example, if we're honest, it's a market that we want to grow into, the residential specialist market. It's always been a big part of us, but we see more growth in it. The buy-to-let market is under pressure. It's been squeezed due to taxation changes, increasing the stamp duty, and some changes in dynamics there. We've seen more PT business go through with brokers. So finding additional avenues, especially for specialist lenders and probably similarly for high street lenders, is really important. So we're investing a huge amount of money in modernisation and IT infrastructure, not just to enable us to do more business, but to be able to do different types of business. And that product innovation we mentioned is really important to us. We want to be able to do different types of schemes that maybe our current systems don't allow us to, which we will be able to do in the near future. So for us, it's a really important market, and I think more competition can only be a good thing for customers, and I think that's definitely what we're starting to see: more lenders showing interest and more competition.
Brilliant, fantastic answers both. Thank you very much. We've got time probably for a couple more questions. So the next question, as we all know, as part of the whole chain, one of the most important things is actually the property and finding the right property. Mornay, if I could just direct this one to you, if you don't mind. When first-time buyers are actually going to look for their first property, what are the key things a broker could suggest to them to focus on to stop the property being the reason the transaction falls down?
Oh, good question. I think first of all, it's the broker plays, like I mentioned earlier, the broker plays an absolute key role in sort of guiding that consumers through the whole process. I think if you look at the properties and the advice from for first time buyers, it's around the direction of travel for home ownership, especially when you start bringing sort of the UK's ambition for net zero, etc., and especially then linking in with new build type properties. New build properties are more energy efficient, therefore more energy efficiency sort of means lower bills, and especially sort of in an environment where we sort of see average sort of energy costs sort of absolutely soaring, really. So, but also sort of that guidance around the affordability piece. It's the first time in a generation, as quoted by industry, that first-time buyers don't really have a supporting mechanism to actually get them onto the property ladder. And this is the beauty sort of shared ownership. It's been a consistent sort of product offering for many years now, and sort of been tried and tested, and it's been very successful. So I think there's a lot to obviously talk to a first-time buyer about. But I think overall, with look at lender focus and that side of things, especially sort of bringing in consumer duty and the importance of home ownership, but from a social economic point of view as well. And I think there's evidence of home ownership providing stability, and especially for children and younger number of sort of youth crime and that sort of thing. So I think as a society, it's absolutely important that we all sort of pull together and support first-time buyers as much as we can, really. And guidance, support, and advice is absolutely key to that.
Absolutely agreed, Mornay. Thank you very much. Catherine?
Just wanted to add a bit more of a sort of human lens, dealing with customers on a daily basis. Knowing what they want to spend on a monthly basis on their housing is really key to them, because that drives the price they're looking at. Where they want to buy as well, you know, what they want, do they know the area, what they're looking for, what will they compromise on? Because if the risk when you're buying a property is that you haven't made those decisions up front, and that's where we find customers cancelling or deciding to do something different, is when they haven't thought all of those processes through before they enter into it. So making sure they know what they're compromise on is one of the really key things from our point of view.
That's a great point, Catherine. Thank you very much. And for a final question, probably start with you, Catherine. This is more pointed towards probably yourself and Kelly, because what I've seen from some of the questions that have come through, there has been a lot of questions around shared ownership, because we know that not necessarily every broker would specialise in it, and it's quite an intricate avenue. So for any brokers out there at the moment that are on the webinar and who are about to submit their first shared ownership application, or are feeling, right, I'm going to take the plunge and I want to start, doing shared ownership as opposed to sort of, referring them on. What are your top tips to help them be successful?
Kelly, do you want to go first?
Come and work for TMP? No, that's not the right answer. Learn the capital funding guide. I can't stress that enough. The common mistakes we see is the conflicting advice from non-specialist brokers through to specialists. Read it, learn it, talk to housing associations, read policies, and become a specialist in what you do. Because it is a specialist area. It's not rocket science, but it does come with different layers of complexities, different rules, different considerations when working within it. And if you get that bit right, the rest is actually pretty simple. I feel that as a broker, we're in a lucky position because we only really have 30 lenders, but in reality, probably 12 that we work with. You know, we work with Leeds and Kent Reliance constantly. We know their criteria inside out and upside down. But I'm sure if you came to one of my brokers and asked them about a buy to let, they'd scratch their head and take a little minute to go and work out what that is first and then where to put it. So just if you want to engage or you want to be involved in the specialist market, become a specialist. And that's not me being facetious. I just think that's really, really key.
Yeah, and I'd echo what Kelly said and make sure that you get to know your housing association, speak to them, find out what's really important to them and how they operate, what timescales they operate within, because sometimes things can take a bit longer than you would expect.
Brilliant, thank you. And look, very conscious about time. We could have probably gone on for a lot longer just with the pure sort of passioning and we've had from you guys, but also the engagement we've had for everyone that's tuned in. You know, we're now coming to, well, we're now at the end of today's webinar. So, you know, please join me in thanking, you know, our industry colleagues for their time and their expertise and all the information that they've shared with us. I hope you've all found today's topics very insightful. If you did want to know more about Leeds or Precise's first-time buyer propositions, you know, please contact your local BDM, fully equipped to enhance on everything that Clive and Ian have gone through today. Special thanks though to the person that we've had sort of in the background, Mr. James Chutter, who has been, you know, instrumental in putting today's session together as well. It's been well worthwhile. So thank you everyone for joining. Take care, enjoy the rest of your day, and we'll get through to the questions after today's session. Take care. Thank you.
Everyone. Bye-bye.
Bye.
I'm just reading. Apologies, I'll drop off in a second. I'm just reading through some of these questions, really. Oh, you're on mute, Andy.
Sorry, I uncamered myself and didn't unmute. If there are any questions there, though, guys, that you want to pick up and you want to answer, please feel free.
I haven't even started looking through them.
There were some great questions we had today.
What I'm going to do, teams, I'll get all the questions out of the chat. I can take them all from there, and then I'll share them, and then I'll do my best, because some of the details on some of the questions, I don't have their email addresses, so I've approached one or two on LinkedIn already to see if we can get their contact information and go back to them all. But I'll share them in the email chain. But yeah, massive thanks again to all of you. You did a fantastic job. Really well done. Yeah, so I'm going to end the full meeting now, so everyone's going to get kicked out.
Thanks, everyone. Take care.
Cheers, everyone. Thanks very much.
Okay. Cheers. Bye.